CPIF is Charter Hall's flagship industrial fund with $14.4 billion worth of assets under management. Recognised for our approach to customer partnership and sector leadership in ESG, we have a track record of delivering long-term outperformance for our investors through our focus on acquiring, developing and managing high-quality industrial and logistics assets strategically located in major Australian capital cities. We have curated a geographically diverse portfolio of 130 properties, currently sitting at 99.8% occupancy with a weighted average lease expiry of 10.2 years. That is underpinned by resilient tenant covenants. The Australian industrial and logistics market fundamentals are as strong as ever, providing significant opportunity for CPIF and our investors. Australia has the tightest industrial market in the world, with record low vacancy rates averaging 0.6% nationally and scarcity of serviced industrial land along the eastern seaboard driving strong sector rental growth. Over the next decade, population and economic growth in Australia is expected to significantly outpace other major advanced economies, while boosting the world's wealthiest population on a per capita basis. Importantly, Australia's underlying population growth is driven by young, skilled migrants who have immediate and significant consumption needs when they relocate. This has a significant knock-on effect in consumer demand and the need for additional industrial and logistics facilities in a country where demand for space is already outpacing supply. For example, an additional 2 million people are expected to live in Australia in the next 5 years. Based on historical demand and current capital values, the projected incremental requirement for industrial property is an extra 7 million square metres or $25 billion in value over that time. The rise in e-commerce has been another key driver in industrial property growth, with significant runway remaining. Australia is in the early stages of e-commerce growth compared to other major advanced economies. Online retail spending currently represents around 12.7% of total retail trade and is forecast to increase to $95 billion by December 2027, almost double the $53 billion recorded in December 2022. Australia's online penetration rate is forecast to increase from around 13% to 23% by 2027 to become the 5th highest in the world and will require an additional 4 million square metres of logistics space to service. Factors like a focus on supply chain resilience, increased cost pressures and a rise in automation have shifted supply strategies in favour of holding higher inventories. As these supply strategies shift, large omni-channel retailers prefer cross-sector property partners like Charter Hall that have the capability to deliver integrated solutions by understanding their needs across industrial and logistics, retail and office. CPIF delivers long-term, market-leading returns from stable, long-leased assets underpinned by strong tenant covenants. With an economic backdrop of rising interest rates and expanding real estate capitalisation rates, CPIF's FY24 results saw a 2.2% or $210 million net portfolio valuation uplift, driven by 17.8% growth in rents and margin recognition from completed developments. Resilient consumer staple tenants now make up 52% of the CPIF portfolio, providing robust and growing cash flow as global economies slow and discretionary spending falls. We build long-term tenant-customer relationships with the likes of Coles, Woolworths, Audi, Amazon, Australia Post, Asahi and Coca-Cola to meet their national real estate needs and provide assurance for ongoing future resilience. Rental relativity of the portfolio is 14% under-rented, which provides opportunity to realise uplift across the expiring stable assets and $1.9 billion uncommitted development pipeline on our residual land holdings. 30% of the portfolio leases will expire over the next 5 years, providing opportunity to take advantage of the forecasted rental growth. Our develop to core strategy and significant committed pipeline continue to improve the portfolio quality and create enhanced returns for investors through accretive development margins and yields on cost. As always, we continually monitor market conditions to maximise divestment and capital recycling opportunities. CPIF's active capital management strategy ensures access to sufficient funding of $2.5 billion from secured liquidity sources, including selective divestments and partnerships to manage risk and opportunity while maintaining target gearing. Our dynamic approach to divestment and co-investment opportunities, such as the current CPIF JV opportunity being discussed with existing investors and targeted new investors, creates further headroom and access to funds. Over the last 5 years, CPIF has averaged $1 billion per year in gross capital raisings, including secondary trade clearances. And over the past 16 and a half years, we've achieved a 12.3% equity return, equating to $4.4 billion of value creation for our 80+ investors. We're actively working with new and existing investors to raise the balance of CPIF's open primary equity raising and to ensure capacity to fund pre-commitment opportunities in CPIF's uncommitted development book. In FY23, CPIF raised over $700 million in new equity from existing and new investors, including dividend reinvestments, and satisfied $265 million in secondary transfers for investors. In terms of our debt strategy, we take a prudent management approach to CPIF's debt book, and we're reviewing FY25 debt renewal options to diversify across different sources with well-spread maturity, improved weighted average cost of debt, and hedge profile. We'll also work to maintain our Baa1 Moody's credit rating and ensure a sufficient buffer to covenant thresholds. In FY23, we diversified our debt book with over $1 billion in additional debt facilities from both domestic and foreign lenders, with our 30 June gearing at 21.8%. CPIF continues to have healthy relationships with existing lenders and strong demand from new ones. This was recently demonstrated by our successful $1.25 billion Asian term loan, which was 2.5 times oversubscribed and on highly competitive and favourable terms.
We are focused on the opportunity for CPIF to deliver returns above the 8.5% forecast equity return over 5 years by unlocking embedded alpha in the portfolio. The funds team is focused on 4 key strategies to achieve this. Maximising value on properties with low site cover. Driving pre-commitments with major tenant customers and delivering improved margins through our development pipeline. Asset repositioning, unlocking further rental reversion and returns, and an intensified focus on ESG. We'll start with the first aspect of our strategy, maximising value on properties with low site cover. CPIF's portfolio average site cover ratio, or building size to total land area, is currently 35%, compared to a standard industrial average of 50%. This means we have an additional 1.4 million square metres of gross lettable area that can be unlocked in the stable portfolio. Improving portfolio site coverage would realise accretive rent and margin that isn't included in our current forecast returns. Arnott's food production facility in Huntingwood in New South Wales, which CPIF holds a 50% interest in, is an example of the unrealised site cover potential. Arnott's received development approval for a proposed 23,000 square metre expansion of this manufacturing facility, which would include new basement car parking and a production area suitable for 4 additional product lines. The 43,000 square metre high bay structure can store approximately 28,000 pallets and allow Arnott's to store and distribute directly from its Huntingwood site. The second pillar of our strategy is driving pre-commitments and margins on CPIF's development pipeline. By leveraging our team's expertise, platform-wide scale, together with our strong tenant-customer relationships, we can deliver improved margins and reduce risk from our development pipeline. And we are confident CPIF can derive further positive rental reversion in the national land-constrained markets to further enhance returns. The backbone of our development strategy is partnering with tenant customers to deliver develop-to-core facilities that further improve portfolio quality. CPIF has delivered close to $1 billion of assets across 12 projects in the last year for key tenant customers, including Coles, Bunnings and Australia Post. We have a considerable committed development pipeline over the next 4 years, with an estimated gross asset value on completion of $2.9 billion and a weighted average lease expiry of 15.8 years. Uncommitted land holdings continue to receive strong inquiry levels, and we're confident that we'll further generate returns by leveraging these great market conditions and executing on our uncommitted development pipeline. Lastly, CPIF continues to mitigate construction risk by partnering with Tier 1 builders on gross maximum fixed price contracts. The third aspect of driving additional alpha from the portfolio is asset repositioning. We've identified around 3% of the portfolio, or $426 million of gross asset value, for near-term repositioning, which has embedded leasing upside. For example, Smeaton Grange Distribution Centre in Sydney is available in March 2025 with vacant possession. This provides an opportunity for the asset repositioning in the Sydney market, which is experiencing a chronic undersupply of industrial property. Our final strategy focuses on unlocking the embedded ESG value in CPIF's portfolio, which includes collaborating with tenant and investor customers to invest in clean technology solutions such as solar, batteries, and electric vehicle charging. By accelerating our approach to renewables across the portfolio, CPIF can deliver additional returns not already contemplated, which will support our tenant and investors' customers' ambitions to reach net zero. Again, Arnott's Huntingwood facility is a great example of this. Arnott's had originally committed to net zero for Scope 1 and 2 emissions by 2040, but has advanced this trajectory by close to 10 years through one of Australia's largest behind-the-meter solar installations. Arnott's now generates 5.25 gigawatt hours of clean energy annually at Huntingwood. This facility features 4.1 megawatts of rooftop solar system comprising 10,000 solar panels and a 15 megawatt hour battery system. We are proud to support this type of innovation and investment that shifts the dial when it comes to emissions reduction and ESG leadership. CPIF has identified the ability for rooftop space to provide solar capacity with the potential to unlock rooftop leasing and accretive carbon credits. Our total clean energy investment includes 23.6 megawatts of solar panels already installed, with a further 7 megawatts of solar due to be installed by December 2023. We have installed LED lighting across 80% of the portfolio and smart metering for energy and water usage across 70%, providing valuable operational savings and insights for our tenant customers. We're committed to electric vehicle charging stations on all new developments and continue to roll out these initiatives throughout FY 2024 and beyond, with a focus on continued ESG alpha creation for our investors. Sustainability is integrated into everything we do. CPIF achieved net zero for Scope 1 and 2 and set our near long-term Scope 3 targets in FY 2023. In FY23, CPIF's standing investment GRES score improved from 80 to 83, achieved 4 stars, and is recognised as the second most sustainable industrial fund in Australia. The fund also improved its GRES development score from 86 to 94 and is committed to ongoing improvement in FY24 and beyond. These ratings demonstrate our ongoing leadership and commitment to sustainability in buildings and throughout the asset life cycle. The strength of our business relies on the strength of our communities, which is why we continue to partner with organisations like Healthy Heads in Trucks and Sheds, championing mental health and wellbeing for all people in the supply chain sector by building healthy and thriving work environments. In FY24, we will continue to create enduring impact in our communities by funding employment and training opportunities at key developments through our partnership with Settlement Services International.
CPIF remains well positioned for resilient future growth with a demonstrated track record to deliver on our strategy, supported by strong market fundamentals and ongoing sector tailwinds. We continue to benefit from the size and scale of Charter Hall's national platform, with deep expertise that enables us to identify and capitalise on opportunities to unlock value for our investors throughout the cycle. We continue to deliver stable income and capital growth for you, our investors, and hope that this video and the accompanying operating strategy provides you with meaningful insights. The FY24 operating strategy is available in the CPIF data room, and we encourage you to contact myself or Anna if you have any questions. Thank you.